All right. Well, Kyle, thanks again for doing this. I really appreciate you, man.
George, thank you so much for having me. This is great.
We were just, I kind of wanted to have a bit of this on the record, but for those either seeing this or maybe just audio, Kyle is rocking a very decent and solid mustache right now for Movember. And you were telling me, so you're doing, I think it's up until December 6th, and the gig was that if you can pull it off till then, you have to do a stepbrother's portrait with who was the other counterpart?
So my co-founder. So one,
Co-founder. Derek?
yeah, thank you. I can check something off my bucket list because I always wish that I could go on a podcast and someone would say I have a very decent mustache. So like, check, I nailed that one. Yeah. So the plan was we were going to raise $5,000 for Men's Health through November with Clearcover. Our chief product innovation officer raised it in like 10 minutes because he agreed to shave his beard live on an all hands and leave the mustache if we hit the goal. And of course, we hit it in like 10 minutes. So then he challenged us to do our own thing. So I said, well, look, if we double that goal in the next week or whatever it is, Derek, my co-founder, and I will grow out our mustaches for the rest of November. And at the end of the month, we'll get a stepbrother style family portrait done with our mustaches on. And we, took another couple hours and we hit $10,000. So now on December 6th, Derek and I will be heading to a J.C. Penney portrait studio in Argyle sweater vests to get our stepbrother's photo. And then I think it'll be gone.
Dude, that's a lot of demand. I mean, it's for a good cause, but I'm just saying like that. There's a lot of people who want to see you in those sweater vests doing that portrait. It must mean something.
I think it means they don't realize what they bargained for yet, but we'll find out after the photo.
That's jokes. Well, no, good on you, man. Jokes aside, it's always for a good cause. For those wondering, by the way, Kyle Nakatsuji, hopefully I'm saying your last name correctly. I want to touch on that in a second, but Kyle, you're the co-founder, CEO of Clearcover. Of course, for everyone listening, including myself in Chicago, very familiar with this unicorn now stage company. I can't even call it a startup anymore, but for those curious, Clearcover is really, and this is verbatim how you describe it in a nutshell, it's a next generation auto insurance company. It uses tech to create a better cost structure for people actually using the platform, better user experience, i.e., that means you end up paying less on your auto coverage. So it's a really kind of solid platform, and just wanted to give a segue for people who might not know you or be aware of Clearcover, but hopefully that does it justice.
It does, yeah. Thank you. It's an insurance company. We just use technology and we distribute the product in some interesting ways, all of which allows us to have a lower cost structure. And in this business, lower costs means you have more money to do things that customers actually want. So it's not the sexiest business model in the world, but it tends to work, and we're sticking to it.
It is kind of true though, right? Like if you ask anybody within the tech community who's trying to disrupt an industry, insurance is one of those verticals that seems to always be associated with a connotation that it's not as sexy. And I'm assuming a lot of it has to do with it being maybe manual or paper-based or old school or whatever you want to call it. What were the challenges that you saw within insurance, similar to like fintech for finance is very regulated as an example? What were those hurdles for you early on in, let's say, 2015 or 16 when you and Derek were putting this together?
That's a good question. I mean, I think the big challenge for insurance generally has been the industry tends not to be very customer centric. The industry is very much, it's old. It's been around a long time. And like, I think an industry that has been around that long and frankly has seen that much success tends to have a bend towards incrementalism. Like they tend to work on the next thing that modestly improves some really massive part of that business. And that's not a bad decision. That's often a very rational choice in these businesses. And so what we found is that incrementalism was sort of leading the businesses away from customer centricity. We were focused more on like the next thing we could do and less on what was really important to the customer or what really mattered to the customer. And so we said, customer centricity in this business in particular is like a temporal question, which is to say, to win at this game, we'll touch on this many times, I'm sure, but this is like a 20 or 30-year game. And to win at this game, that means that your customer centricity needs to stretch over that window of time. So it's not the cool thing you do today. It's what enables you to do all of the cool things you need to do for customers over the next like 30 years. And when we unpack that, the core ingredient, the key to being customer centric over that 30-year window was cost structure. Because put simply, if you can run your business at a lower cost, that creates an economic surplus, and you can invest that economic surplus in whatever that customer centric thing was at that time. And like we felt, one of the big hurdles here is the industry is not super customer centric. And frankly, a lot of those who are trying to innovate are focused on these very temporal customer advantages and not necessarily building a foundation to be customer centric for the next 30 or 40 years. And that is why we started the company. That is still our aim today, is to very much play that long game and build an organization that we think can thrive and be customer centric over a very long period of time.
Yeah, I mean, one of the favorite things when I was doing some homework on this episode in particular, I love this thing you mentioned, and you mentioned it actually a couple times. I realized you said it like with Christy Ross, if I'm not mistaken. Shout out to Christy on Tasty Trade, and I think another podcast. But it was like taking the guesswork that the eventual client has to deal with. The less guesswork they have to do throughout the process, the better. I want to tie this into another question though, but you also mentioned, which is very true, like with our more, let's say, traditional businesses, they typically have these like very old legacy systems that they have to deal with. And it's often more costly, as you were mentioning, for them to like not do or not continue doing all of their old legacy processes and do new things. How did you, when you guys were first starting out, how did you create a business that actually competes versus just complements like an add-on basically to what they're already doing? Those are two very different pathways, right?
Yeah. I mean, the origin of the business, my co-founder and I were both at American Family Insurance, who is great and been a fantastic supporter of us from the very beginning. And, we had this idea around, loose idea, by the way, right? Because I've said this before too, but like every startup's origin story is just like some post facto rationalization of all the things you actually discovered along the way. And then you just like mash up all of your learnings into what you theoretically knew at the beginning. So, take it with a grain of salt. But like we had this notion that, if you could, cleverly distribute the product, use new technology, sort of do a couple of things right, you would create a lower cost structure. And with that lower cost structure, you could do all these great things we're talking about. But the key to and again, I think you're referencing it, if you're going to build a better cost structure, it's not enough to do the new things. You have to stop doing the old things. Mm. And in some of these very large and established businesses, that's a hard thing to do. Right? Like it is a very difficult and risky proposition to unwind things that have worked for a very long period of time, and that a lot of people in the organization have a vested interest in protecting. It's a really difficult thing to do. So our belief was, if we're going to do this right, we have to start from a blank sheet of paper. We have to have no old things to start, so we can only do the new things. And that combination would lead us to actually create that advantage cost structure, which is what we're seeking. So we didn't have a choice. It wasn't like we didn't believe we had a choice. We didn't think we could create the environment necessary for success inside a place that already knew how to do. And to be frank, they knew how to do the things we wanted to do way better than we did. So there was a lot of risk involved in saying like, look, we're going to basically start from scratch, even though we don't really know what we're doing, because that's the only way we can create the conditions sufficient to win based on the strategy that we have. And that there's definitely a trade-off there, but it was the only possible way we thought we could create that cost structure that ultimately became the foundation of the business.
Mm-hmm. Yeah, I heard you say that it wasn't back to the thing about like where the light bulb moment came out, which is often a question I enjoy asking founders, but it's kind of cool to hear you say like there wasn't really a eureka moment. It wasn't like as much of a massive momentous occasion, as much to your point as like the accumulation of different ideas that built into this perfect timing to do this one or tackle this one problem.
Yeah, that's right. I mean, what you do is as a founder, you take many small discoveries and frankly, many large mistakes, and then you sort of compress them through time into a eureka moment when you tell the story. But the reality of it was we had an inkling, we had like a theme in mind of how you would build something enduring in this space. And then we went out and started working on it, and we learned and we made mistakes and we course corrected. But the thing that, we're very fortunate today to be able to say is our North Star, this idea of, winning on cost structure as a function of being customer centric has remained our North Star from the very beginning. So while we've made, course corrections along the way, we haven't had to make any sort of dramatic pivot. And I think as a result, we've been able to make a fair amount of progress in a short period of time, because while we made many mistakes, they were all directionally towards this thing we were aiming for, which helps.
How do you get validation though? Because I feel like with pivots, to your point, it's like you typically get negative validation that what you're doing isn't either working or serving the customer in the best way possible. So how did you constantly get this like small pat on the back to make sure that you're kind of following that North Star?
We made a lot of mistakes, but we used leverage to our benefit, which means we decided to work on the problems that we thought required the least amount of work and could generate the most amount of output.
Mm-hmm.
And in our business, that means we went to work trying to lower the price of insurance. So we didn't have a problem of customers not liking what we put out to market, because another way to think about our strategy at the beginning was we think we're going to have lower costs. So we're going to go sell this thing that people are forced to buy by the government for less money than they can buy it in another place. And that is a recipe for people to say yes, right? This is a compulsory product. I'm selling it for less money.
Pretty straightforward.
Say yes. And in fact, in the beginning, too many people said yes because we didn't know what we were doing. So it's like it was a very different set of problems. So we made a bunch of mistakes, but we did have like a bunch of reinforcement along the way that the idea we had was right. And if for no other reason than because the idea we had was dead simple and quite obvious, which is I'll just sell the thing people are forced to buy for less money and they'll like me for it.
Because I know that you and Derek both emerged, I think you were a principal for sure at American Family Ventures. So you were basically on the sourcing, evaluating, structuring side of the investment side of American Family Insurance, which I think would have been a very cool job segueing you into Clearcover today. But how was that conversation like, maybe if you pitched it to I don't know, because they backed you, obviously. They were the first backers of you, right? And they're still investors and they've been with you since the inception. But how was that like beginning conversation with whoever your teammates were, colleagues or managers?
So I was living in California. I came back to Madison basically to sell our condo and move out to San Francisco full time to open an office for American Family Ventures there. And when I got back, I heard Derek, who's my co-founder, was working on a project at American Family that they were calling insurance as a service. It was basically that an idea around our initial thesis on distribution, which is you can integrate insurance into some other product and experience, and it will be more convenient for the customer. It'll be cheaper to distribute, et cetera. So this was back in we started working on this thesis in like 2014. I wrote a paper on it back then. And then Derek was working on this early 2016. I came back and I was like, oh, that's interesting. I went to my boss at the time and said, can I spend 20% of my time hanging out with Derek and that crew and just seeing what they're up to? Because we're investing along those lines too. He said, yeah. So I just started showing up at Derek's meetings. I only realized like a year ago, honestly, telling this exact story, that I never asked Derek for his permission. I just started going to his meetings and like inviting myself to all the stuff they were doing, and he didn't kick me out. So appreciate it, Derek. But so we worked on it together for maybe a couple of weeks, much to his chagrin, I imagine. And then it became quite obvious that, as we said, like if we're going to pull this off, we probably need to create a new company to do it. So we went to the gentleman who hired me, a mentor of mine, a fantastic insurance professional who's a ton of success, Peter Gunder. Said, Peter, hey, here's what's going on. Like, in order to do this right, we're going to need to quit and start a competitive insurance company, but don't worry, you can fund us, so you'll own a piece of the success. And Peter's like the nicest guy in the world, but he was like, look, this is never going to happen. Like, this idea is dead on arrival. You're never going to get this across the finish line here. And we were feeling entrepreneurial, so we were like, okay, that sounds like a maybe. We'll come back when the story's a little better.
Taken.
Exactly. So we worked on it for, a handful of months. And, Derek, to his credit, was like, hey, I do want to do this with you, but like, I can't blow myself up along the way here. I got a family. Like, you got to tread a little lightly here. I was like a little less inclined to tread lightly, which I think was a good combination for the two of us. And eventually Peter, um, heard the story in a way that he thought was compelling enough that he took it to American Family CEO Jack, and American Family CEO Jack is a visionary, and he really is like, you know, championed innovation at the business before it was cool to do so. And Jack, said, Peter, if you believe in this, I'll back you. And so but between the two of them, like they were like, fine, give it a shot. And as soon as that happened, the thing was on the rails. We were out and started the company in like a month. So it was a bit of a journey, but we owe all of the opportunity we had to leave and try this to a handful of individuals. Dan Reed, who was my boss, they're like a handful of people who were creative, thoughtful, and bold enough to say, yeah, on its face, this is a crazy thing, but we believe it's the right thing to do, so we'll back you up.
It's kind of cool to hear that too, because I feel like for a lot of aspiring founders, they see the whole college dropout and, I've never worked at a corporate. It kind of comes with this, again, negative connotation, like it's not the sexiest path to do it. But I feel like there's so many advantages. Case in point with you, and we'll touch on the legal side, but for those wondering, like you have a JD MBA as a background, you had a small stint with a law firm at some point, but then when you moved to American Family, like that's really what propelled everything else. So maybe if you segue differently or you stayed in law, like who knows how that trajectory would have happened. But I think it's important to point that out, right? Like that your success in entrepreneurial world was also part of the journey for you being in the corporate world as well. And maybe you recognizing the pain point, right? That eureka moment that you were talking about.
Yeah, for sure. I talk to entrepreneurs. So certainly insurance was not manifest destiny for me. I didn't know a thing about insurance. I think I was on my mom's car insurance policy till I was like 26. So like, it's like, that was not a thing. Entrepreneurship, I was very drawn to. I like to think I would have found my way to this profession, at least at some point along the line. But maybe not. But what I think more than anything is, as like a hopeful entrepreneur, is it's you, in order to like find a thing that's worthy of starting, have that thing be successful, at least sort of look successful. Our story has not been written yet. Have the chance to grow it. There's luck involved everywhere, right? You really, really just have to get lucky, and you have to get lucky a lot. And the only thing you can do to help your odds, in my opinion, is to increase the surface area of your luck. You can't force yourself to be lucky. You can increase the surface area upon which you might get lucky. And for me, law, American Family, being around entrepreneurs and in VC, all of these increase the surface area upon which I could get lucky. Lucky in terms of stumbling on an idea that made sense. Lucky in terms of meeting somebody who could help you think about something in a different way. Lucky in terms of meeting somebody who's willing to bet on you early in career when somebody else might not, right? And like it's you can't manifest these things into existence, but you can do things that increase the surface area of those of like those moments happening in your life, and that has made all the difference for me.
Yeah, I love that analogy. Again, I'm glad you said it, because I did listen to it, and it's such a great way of explaining it, to be honest. I always have this conversation, put it more mildly, because my fiance might listen to this, but with my fiance, and she's
very cordial conversation.
100%, man. There's nothing thrown back and forth. No, but it's a good one too, because we come from very different perspectives. She's a training psychologist, so I always learn from such a very different mindset, and I come from more of a business sort of capital markets, finance background, but we always talk about luck in particular. And I'm more of the mindset, at least more previously, it was always like manifesting and, you create your own luck, that sort of perspective. But recently I've really been in tune with how lucky, and even like the word privilege has been coming up a lot. I think just in broader society, but even in my own life, like actually pinpointing back to how lucky you are even as a child, with your parents, where there's so many things that you weren't in your control, and you just, you had a certain pathway that led potentially to where you're at. And I just wanted to clarify too, I think that regardless of if you stayed in corporate, I think you have the entrepreneurial DNA, obviously. And I think some things that maybe grew that surface area were also being observant, right? Being proactive. Like nobody forced you to go and go into the room with Derek as an example, or create that relationship or pitch that idea. So there's a lot of things I feel like folks can take away just from that, the subtleties in your story? It might not be as apparent, but it was always there, really, which is kind of cool.
Yeah, I think you're right. I mean, there's certainly inherent characteristics you would hope to find, whether it's stubbornness or, persistence and grit and like inquisitiveness, and I think all of these things are again, they're necessary but insufficient conditions to like create an entrepreneur, and particularly an entrepreneur who like grows a business that gets up to some size. It also, you just have to get lucky, and you can't force that. You just have to try and optimize your odds of getting lucky.
Yeah, and always do shit and then ask for permission later. I think that was a big one. I didn't want to leave that unnoticed, man. That's a critical one right there.
Yeah, that doesn't always work in your favor, but more often than not.
Yeah, probably does. The one thing that you and Derek, I think, recognize, which you talk a lot about, I want you to say it, obviously, but there's almost like 4 pillars as to how you've helped consumers build that confidence, right, in your product offering. And I'm curious, like, it's cool to hear you say it, but like in retrospect, it feels like it's so difficult to have all 4 pillars be executed. So which ones did you tackle first? And if you don't mind actually saying what those 4 are.
Yeah, of course. So thanks for bringing it up. So if we go back, by the way, to the strategy here. So the strategy is, use technology, use your business model, create an advantage cost structure that creates an economic surplus. You invest that in things customers want. So what do customers want? Well, the end of this story is we call it our customer confidence loop. And we think, every great insurance experience that builds confidence in a customer is comprised of 4 things: transparency, convenience, affordability, and value. Those are the only 4 inputs to a great customer experience. But as you suggest, they actually exist in balance. They're not singular entities. So for example, it would be a tremendously convenient experience for you, George, if when you came to Clearcover's website to buy insurance, I took your full name and then gave you a policy, right? Like that was easy. All I got was your name, and here you go. Now I know what to write on the card. It turns out that that's very bad for affordability, because the only way I can possibly do that is if I charge you like $20,000 for your policy. Right? Like I need more information than that to figure out how much you should actually pay for insurance. And so now I have to like start to trade convenience against affordability, right? Like how much can I ask for? If I don't ask for a thing, do I have to charge a little bit more because there's this unknown variable in your equation as an insurance risk? How much, do I promote myself versus some other company who might actually have a lower rate for you? Do I service that to you? Do I not? That's transparency, but it, might make it harder to buy the product. It might not help me out as a business. So all of these, like these 4 things: transparency, convenience, affordability, value, they have to exist in balance. And in our view, the way that you can get them to exist in balance is, 1, you create that economic surplus so you can invest effectively in them. And 2 is you listen and you build your business around what customers need. You figure out who your customers are and what they desire and what balance means to them. And then you go invest in making those things happen. It's a tricky proposition to get right. They're very simple things. They're hard things to make sure you can properly invest in and then keep in balance.
If you had to pick, and I appreciate that, it seems to me like they have to be in harmony, and sometimes it's probably like a pendulum. I'm assuming sometimes, maybe the like one will go down too far and you have to bring it up and sort of balance each other out. But if you had to pick one, and I sort of hate asking this question, but if you really had to pick one of the 4, which one do you think is the most important, at least to start with?
It doesn't matter what I think, but our customers will tell you affordability. It's like, if you think about like, the insurance hierarchy of needs,
right.
We have to have some like basic level of like, okay, this is a good price for what I'm getting to start with. And then we can build on top of that. But like, no matter what else I give you, if I charge you a stupid amount of money for the product, one that is fairly commoditized and you can get in many places, I lose and you won't, right? So like it's not, we've talked to customers about this plenty. Price matters. It matters a lot. There's no avoiding it.
There's also like the cost of moving platforms, to your point. So I think the cool part is like understanding what that hierarchy is. And when you identify that cost is probably at the top of the pyramid, understanding that without that, people won't move from a legacy business they've been dealing with for years or centuries, right? Like I think you probably had that because it's the same with finance, right? Or even a marketplace. Like if a version of Facebook came out today when Facebook was actually popular for us here, the real question is like, why would I move to a new marketplace when I'm already in one that has 3-4 billion users?
Yeah, that's right. I mean, look, we as insurance consumers, we have been classically conditioned over the past, 25 to 30 years to expect lower rates, right? Like every funny commercial you see is like a Pavlovian bell, low rates, funny commercial, low rates, right? Like that's what's going on. We're just being told what we should care about is getting a lower rate. And like behaviorally, that's a tough thing to fight about. And also it matters. I get why it matters.
Yeah, the transparency one is at least to me another one of those things. Again, I'm always comparing this to finance because that's the field I'm in. But I feel like if you look at which I'm not in this space, but if you look at the advisory space, it's no secret why millennials, Gen Zs, the younger generation don't trust their financial advisors as much because I feel like they've failed to be transparent in a simple diplomatic way, right? Like they've been using acronyms to sound more complicated and that they hold more of an asset than they may actually do. And did you find the same thing in insurance?
Yeah, look, I think insurance is a very opaque product. Part of that is the nature of the product. Part of that is how the product has been sold. Part of that is the fact that people don't want to engage with the product because, things that are opaque tend to stay opaque if people don't care to learn more, or to dig in, or like it's boring and not worth their consideration. Insurance is one of these momentary concerns for most people. It matters in the moment you need to get it, and then it matters in the moment when you need to use it. And beyond that, people don't spend a lot of time thinking about it. That's like, the classic market research problem in insurance is you bring a bunch of survey group, you build a survey group, you bring a bunch of people into an insurance company and you say, tell me what you think about insurance. And in reality, the question you should have started with is, tell me if you think about insurance or when you think about insurance, right? And like there's a subtle distinction there. And the answer to the first question might be very different than the question of the second, which is like never or rarely, or I would prefer not to. So, I think you got to deal with the fact, like, yes, it is opaque. People also just don't want to engage with it, which makes the transparency problem a little bit harder, but it doesn't mean you can't work at it. And it doesn't mean they can't talk about all of it today, but it doesn't mean there aren't ways to make the customer's life easier and make their insurance experience more transparent and not require a lot more of their attention or energy than they're required to devote to it today.
So really interesting. As you were saying that, I was reflecting on it, whether I even think about insurance myself. And I don't own a car because I live in downtown Chicago, so in the city. But the most recent time I actually did buy insurance was when I got engaged and I bought ring insurance. And I feel like for me personally, that's my mindset. It's like I'd rather think of insurance in the short term so I don't have to think about it in the long term. And maybe that's the right or wrong way to think about it. I'm not sure, but yeah, maybe some other consumers fit in that bucket. How do you think about it, actually, is a question I have.
Now I think about it all the time, sadly.
Aside from Clearcover, though, just as a general consumer.
Yeah, I mean, look, I don't think about it. I am insured by Clearcover, and I don't think about my own insurance much because I don't have to, right? Like it is for most people, for many people, it's a set it and forget it type product. For other people, it's not a cheap product. For a lot of folks, it's a pretty major expense on your monthly P&L. And like, you do have to think about it. Like, how can I afford it this month? Can I have to change it this month? It's like, it's not, it would be disingenuous of me to say it's set it and forget it for everybody. Because for a lot of the country, that's just not how it works. And those people deserve insurance too. So I think there's work to do on that front for everyone. But, all that aside, I think it was one of the earliest thoughts we had in building the business is, I think insurers at the time in the 2014, 2015 window were very desperate to expand their relationship with customers. They wanted customers to think about them more. And we said that only works if you have something useful to offer them. You can't just get them to think about you more because you want them to. Like, they either have to think about you less because that's what they ultimately want, or you have to find reasons for them to engage with a service or a product you provide that gets them to associate you with something they care about more, but not necessarily think about you more. And like that, we have some cool stuff going on in the business where to the value side of our customer confidence loop, where we're able to take that economic surplus and invest it in providing some really interesting value added services to the customer at zero cost to them. And as a result, like, hopefully they have some affinity for us, and like that, they might have a reason to open the app a few more times than they usually would. But it's also not about that. It's about delivering on that value pillar. It's not about, hey, come to Clearcover more. It's about, I'm going to give you something that delivers on that value pillar. And if it happens to make you engage with me more frequently or like me more, then great.
I like that. Speaking of, like, one of I think the fourth pillar was the superior value. You guys recently launched I guess it's a new product. It's called Clear Claim, if I'm not mistaken. It's a cool app, which, man, I thought what you guys are doing, especially in that predicament, is so cool to see in insurance. And I'll let you elaborate more on what it actually is, and maybe walk through the audience or someone listening to what it actually looks like from a user interface perspective. And then just the second question, as you explain that, is like, how are the maybe older, less tech savvy generation dealing with that, or is that even not really your target audience for this particular product?
Yeah, let me start with the second question. We are not a demographically oriented company. We're more of a psychographically oriented company, which is to say, we do tend to fare better with customers who are digitally inclined, who want a digitally native insurer, who want an app that works and can do all the stuff they care about. But that is not, it skews towards certain age groups, but it's not limited to certain age groups. We have plenty of customers who are in the older demographic who actually prefer to engage that way as well. So it's we tend to, focus more on like this idea of the digitally focused customer as opposed to any particular demographic. Clear Claims. So Clear Claims is essentially a product that, it doesn't feel like a product to the consumer, by the way. We call it product because we built it. But basically, here's what happens. When you buy Clearcover, you're prompted to download the app. And like, the app is your home for everything insurance that you got to do. In the app, in the event something happens, you can file a claim. And the process to file a claim in the app is very straightforward, really seamless. Like, you go in, you answer some questions, it really looks great. You take photos of the vehicle if you're around it. You could take a photo of like your ID, the other driver's ID. Like, it just collects a bunch of information using the app as a prompt to do so. And the benefit of that is we're like getting pretty granular information about what happened at the scene and the accident. You give us a description, etc. We then built some machine learning models on the back end that help us identify which claims are eligible for what amounts to an instant payout. So, taking the facts of loss and the photos and everything else into consideration, how do we speed up the process of resolution? So we have this machine learning algorithm that determines eligibility, and consumers then submit that information through the app. If the model tells us you are eligible, then we guarantee we'll pay your claim in under 30 minutes. And the record is 7. So from like click, submit my claim to payment in 7 minutes. And it's a very small percentage of our policyholders now, but it's growing every day because the models get better every day. And like, to your point, that is a convenient experience for consumers. So it hits on that pillar for us. It actually is a lower cost way to handle a claim. So we can reinvest that in lower prices. It hits the affordability input for us. And that element of like being able to file quickly and get your claim resolved quickly is of value to a lot of consumers. So that's a really highly leveraged move for us, because it hits on at least 3 of our pillars of customer confidence, and maybe even the 4th. And so we look for as many things like that as we can, because again, back to the beginning, startups are about leverage. How do you do the least amount of work and get the most amount of output? If I can find things that hit on all 4 of those inputs simultaneously, those are usually pretty good things to invest in.
Yeah, I like that. It's really cool how you're tying also, even from a product level. And I know, we mentioned product. It's more of a startup thing. It's not really from a user's perspective, but it's just cool to see you tie in back to those pillars. And we'll talk about leadership styles in a second. But even like, I think in your most recent financing within that press, there was the stat, I think from McKinsey, that showed that more than 65% of consumers who actually adopted digital claims want to continue to do so even post-COVID. So, all the more testament to where you're treading to. So that's probably a good validation.
We hope so.
Yeah, that's pretty cool. I wanted to ask you one thing before we shift gears. This actually came to mind. I didn't write this down on my notes, but kind of came to mind now. Something that I remember actually when I took business law, and I'm actually really excited to ask you this, by the way, frankly, because of your JD background and where you sit today. So, and I don't know, let's see how this goes. But let's say, for instance, you're dealing with autonomous vehicles. So maybe Tesla or maybe a trucker, as an example, a truck driver. And they were to submit a claim. When the AI is validating a claim, how does it actually discern whose fault it was when, and I'm sure you've probably crossed this ethical path, and I'm not really doing a great job elaborating, but let's say it was the autonomous vehicle's fault, as an example. Will it be more difficult to actually validate this as we see more autonomous vehicles, or maybe less difficult? Curious your take.
The tricky problem. As a side note, I was a crappy lawyer and I barely went to class in law school. So I don't think I've ever been more terrified on a podcast than when you just said, I can't wait to ask you this question because of your JD. So
you're like, shit, disclaimers. Disclaimer.
I immediately knew I had a bad answer to your question. So it is a tricky problem. We have not run into this ourselves yet. So like I can't speak from experience on what it's like to adjudicate a claim when theoretically the car is at fault. But we have thought about how you might handle that type of problem. And this will be the dominant paradigm in driving for a while. It's not here yet, but it's coming. And once it gets here, it'll actually be the dominant paradigm in driving for a while, which we used to call shared responsibility, which is essentially every trip will have two drivers. One of those drivers will be a human. The other driver will be a robot. And the human and the robot will actually exchange responsibility for the trip. And it happens kind of dynamically, right? If you've ever been in a Tesla that drives itself, it'll drive itself until the moment it decides it can't anymore, and it goes rah, 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 and you got to take over, right? Or you're in the left lane and it doesn't want to pass, and you want to pass because you're in a hurry and it doesn't know that. And so this dynamic shifting of responsibility is something we're all going to have to figure out. That will be the dominant paradigm of personal transportation for longer than people want to think. And it's tricky. I mean, I think it's going to come down to, I don't know the answer. If you're asking me, I think it's going to come down to a great relationship between insurers and the OEMs who understand that information, have access to that data. But I do not think the OEMs themselves will become insurers, because being an insurer sucks, and it's a really hard job. And I think they're better off using the data, being a part of the value chain, but not trying to control the insurance value chain themselves.
Right. I guess as a quick parlay to that, when you say shared responsibility, would this be maybe a sort of like how planes have a black box, like some hardware or software to actually document who's driving when? Because that's the only way.
Yeah, right. So the car should be aware of when the autopilot or whatever it's called in everybody else's car is engaged or not engaged. Right. This is always a thing whenever. Teslas don't have that many problems, but when these things happen, right? You watch the news. It's always a question of we're going into the vehicle's data to see if the autopilot was engaged or if the user disengaged it. It's always this song and dance of trying to unpack who was the responsible party in the trip when the incident happened. And that will, I don't think that question will be easily answered for a while, but the answer almost always resides in the data coming off the vehicle.
Understood. Okay, cool. Yeah, thanks for that perspective. I remember taking this in business law years ago, and it seemed early at the time too, and we're trying to think of ethical implications and whatever. But anyways,
I'm just glad you didn't ask me something about trust and estates or professional. Can
I get your personal advice on family trusts?
No kidding. Yeah, exactly. I promise you, if that answer was okay, the other answer would have been much worse.
It's on record, bro. Yeah, I guess segueing to something kind of cool, but I know you don't applicate it that much. But you guys have raised a lot of money, of course, to give folks a bit of perspective. So I think you've raised $329 million to date in total funding. Could be off, but please feel free to correct me. And then your most recent one in April was a $200 million Series D, led by Eldridge, and of course a couple of investors who I guess did follow-on financings. So 329, you have a cool analogy in terms of how you think of financing. I don't know if you can share, but I'd love to hear it again.
Yeah, we think of a financing event as a pit stop during a race. So if you think about, like, I recently got very into Formula One, like the rest of Netflix owners around the country during the pandemic. So
who do you? We got to stop. Just a quick check in here. So which teams are you following recently?
I'm a McLaren guy. I'm a Lando Norris guy.
Lando Norris.
So I got my like Lando T-shirt. I got my Lando McLaren hat. I don it every Saturday for quali and every Sunday for the race. Like I'm a Lando guy through and through. I'm not a Max guy. So, sorry to the Max fans out there.
It's okay. I am.
But Max is great, but he's like been the villain this season. You know, as a new entrant, like it's hard to cheer for the villain. But no, I'm a Lando guy.
Gotcha. Okay, cool. Thanks for prefacing.
But if you think about Formula One, so the race is like an orchestration, right? It's long, and there's a lot of things that go into the race. The pit stop in the race is a necessary part of completing the race successfully, and it takes a ton of effort and coordination. The team practices; they put a lot of hours into making sure that goes off without a hitch. You go and do the thing, and you know when it's completed, you watch pit crews like. They celebrate, right? They're like, hey, they clap, they slap hands, and then they go sit down and they wait and they're prepping for the next time that car comes in and they have to do it again. And so this startup journey is a long race, and a fundraising event requires preparation. It's difficult. A lot of people are involved. It is a necessary but insufficient part of winning the race. So we focus on it and we give it the attention it deserves. But when it's done, we slap hands, we sit back down, and we get to work focusing on the race because, you know, at some point we're going to have to get up and do another stop. And so that's, you know, for us, it is a milestone and a necessary step in the process, but not a goal unto itself.
I love that. That wasn't the analogy I was expecting. I was expecting the gas station one. So I'm glad we had you on the podcast today. I feel like this is an updated version, dude. So I feel like the gas station one was, let me just say really quickly, it was basically, I guess similar in a sense where it seems a bit longer and more taxing every time you actually raise more money because the path to filling gas has becomes more arduous. Now you fill a ton of gas and you actually have an area to go to, so you have to do something with it, right?
Yes, you have to. Sorry, I forgot about that one. I mean, look, the pit stop one we've used for a long time. The gas
when did you
station
pivot,
one was
by the way? Yeah, what series did you move from gas station to F1? Even your analogies are evolving. What is this?
Yeah, no kidding, right? No, I think folks would tell you, I think I put my first picture of a Formula One pit stop up in like 2016 or 2017. Like it's been around for a while. The gas station one, I forgot about that one. But yes, it's a similar concept in that as you get closer, like, essentially the common thread here is as you get closer to, the end of the race or the tail end of the race, or like, as you get bigger and bigger, your team gets bigger and bigger, the stakes get higher, right? And like what you are supposed to accomplish as a result of having made that stop also gets higher. So,
right.
Yeah, it's look, I think at the end of the day for us, the thing we like to convey to the organization is this thing fills you up for the journey, gets you ready to continue on your journey, but it of itself is not something that you should celebrate or be super proud of, because it's just part of that broader journey.
Yeah, it's a weird thing, right, with the tech industry. Like everyone celebrates it so much that it feels like that's the Emmy Awards almost, that constantly happen for startups. Meanwhile, like and every CEO I've had on, literally, I mean, from unicorn to like early stage, they're all like, yeah, cool, we raise money. Like, not to downplay it, but it's like we have so many other things to focus. What you should celebrate actually is what we're about to do, like the growth story that comes after we've raised money, and then actually executing it, and then having me back on the podcast to talk about what we actually did, So
yeah, I think that's right. Although fundraisers they're easy things to celebrate because they're discreet. They're like the numbers are big. Like they hit all the high notes for a good article. So I get why people talk about them. We just make sure that we're not too focused on them.
That's cool. You're a Wisconsin native, I want to say, right? Milwaukee. Are you?
I am, yeah.
Are you a Bucks fan? I'm assuming you are, but
I think you meant to say world champion Milwaukee Bucks, but yeah.
I was just testing you. But that's why. Now I can attest that. Just wanted to see if you were full of shit, Kyle.
Yeah, I think that's what you meant, but sure, yeah.
My man, my man. Well, listen, one of my favorite players is PJ Tucker. I like the I know he's no longer with the Bucks with Miami Heat, but I kind of like the pests almost. You know, the very hard defensive minded players. And Giannis to some degrees, obviously, extremely dominant defensive player as well as offense. But that must have been cool, right? From your hometown. Like, did you ever think the Bucks would ever win a championship?
No, it felt like it was never going to happen. I remember going to um, the Charlotte series back in 2001 when I was in high school, and they actually beat Charlotte, and they went to the Eastern Conference Finals and lost to Allen Iverson and the Sixers, who then went on to lose in the championship. But that was good. They were the big three. They had Sam Cassell and Ray Allen and Glenn Robinson, and like that was like felt like it was our moment. Then
Yeah,
it went away, and like they were bad for a while. No offense to these guys, it was like the Michael Redd, Tim Thomas years. They were just not very great. And then they're the worst team in the NBA, but they drafted Giannis, and like then they felt like they were on the up and up. But I didn't, nobody knew Giannis was going to be who he is, and even the championship run, like I don't know, that series versus the Nets, when they went into overtime versus the Nets, I was like, well, good run, guys. That was it. And then when Giannis went down versus Atlanta and it looked like he was going to be out for like the rest of his career, we're like, all right, guys, good job. It was done. Like there were plenty of moments along the way. It was a great entrepreneurial story, right? Like they're very much bottom of the bottom and then had their own journey of like, even on their way to the top, like so many highs and lows and moments where it almost all went to shit. And
right.
suddenly, they persevered, they fought through, and now, yes, they're the world champ. The early part of the season's been a little rough for us here with injuries, but it's early.
Yeah, I mean, Giannis is literally shaped like a buck, dude. I've never seen a player actually resemble, like who they play for. But I swear to you, I mean, he's the closest human that we have that's actually half deer, half,
He is a
specimen
freakish athlete. You know who your guy is now, though? I know PJ left.
Yeah,
Bobby Portis is your guy now.
I know. I love Bob.
Bobby's.
Yeah.
Bobby's like the heart and soul of the team. Hustle, willing to do anything that it takes to win. He's the guy.
Will die for the ball, like knock out a fan in the process.
Mm-hmm.
Yeah,
That's right.
It's a cool team, man. I guess I know we're running up on. I could talk to you for ages, buddy, but just wanted to ask. I know that you're, I guess, more recently categorized as a unicorn. Your flagship in the Chicago startup ecosystem. A lot has changed, I guess, in your role and the evolution of the company. Just talking through it, like what's been the most exciting? What are you still excited about? How do you constantly evolve? You can touch on any of these things, but I just wanted to weave that in there.
It's not hard to keep learning and growing and evolving as a leader for me because I'm always screwing things up. It's like a constant process and falling on your face and then having to get up and learn from what you tripped over. So I have never struggled to keep finding ways to screw up and trying to learn from them. And like that has been a consistent theme as we've grown the business. The thing that's been most exciting to watch, honestly, is seeing like the organization grow into its own. We're a little over 400 people now. We celebrated our fifth anniversary as a business like a couple weeks ago, and it's been so great to watch people evolve within the business, to see people grow within their careers in the business, to see people leave the business and go start their own companies and like take what they learned and experienced here and go apply it somewhere else. Like that, watching people grow and achieve what they came here to achieve is by far the most rewarding thing. And like that keeps you coming back to that doesn't go away as you get bigger. I think what I'm most excited about for us going forward is there's just so much road left. I said it at the beginning, like this is a game that takes 20 or 30 years to play well. And you cannot win it in a 2 to 3 year window, but you can lose it in a 2 to 3 year window if you're not careful. And so like you're always on your toes. You know you're going to have to play a very long game, and like you cannot win it instantaneously, but there are ways you can lose it. So like it's this delicate balance of saying, if we play the game well, we're going to be at this for a very long time, which is good. And there's a lot left to learn and a lot of opportunity for the business and the people within it to grow. But you're always on your toes, because if you're not careful, you can lose the game pretty quickly.
How do you, I mean, just a question on like, how do you stay motivated? I mean, it's great to say that when things are going really well, I'm sure, but when things are tough, which I'm sure there are also equally, if not more, days like that, how do you keep that mindset when there's so much distraction in the world and the opportunity cost seems to go up every year?
I mean, honestly, it's probably easier to stay motivated when things are hard and they're not going well. It's like asking,
interesting.
Where do you find, it's like asking somebody where they find the energy to stay on the tightrope when the tightrope's 100 feet up and there's no net.
It's like a UFC champion, right? Is that your metaphor?
Yeah, where you're just like, look, that I find the energy because I would prefer not to die.
Yeah.
Like mortality is the source of energy at this point. So when things are hard, it's not hard to come by motivation, because it's like, look, you do this or you do not survive, and you don't want the alternative to work is not an alternative you want. When things are going really well, that's when I think you have to dig into some of that intrinsic motivation, or like find ways to keep challenging yourself, not rest on your laurels, to figure out all the things that's actually broken, even when it appears that things are not broken. Like that's the harder challenge, is keeping yourself and people motivated when your life is not hanging in the balance. I think unfortunately for us, I mean, this has been a journey where our life has been hanging in the balance many, many times. So that finding motivation has never been a big challenge for this company, at least for me.
Yeah, like the wolf at the bottom of the hill is always hungrier than the one at the top. Sort of like that, right?
I love it. Yes.
Last one for you. I promise this will be the last one. But you mentioned a book written by a professor in Chicago. I'm not sure which university, about empathy, specifically relating it to how it's helped you along the financing path to put yourself in the shoes of investors when speaking to them. You didn't remember the name of that book on one of the conversations, so I'm just wondering, do you remember it now?
Yes, it's a book called Mindwise by Nick Epley, who's a professor at Booth, or was when he wrote the book. Mindwise.
Cool. I'm going to check it out. Are there any sort of other books that you've ever really stuck to or passed along?
Yeah, there's a couple. So I'm sure you're familiar with this one, but How to Win Friends and Influence People.
Oh, dude, Dale Carnegie, my boy.
By Dale Carnegie. It's fantastic. It's a must read for anybody in business, in my opinion. Influence by Robert Cialdini was a big influencer on me, no pun intended. Poor Charlie's Almanac is fantastic. If you haven't gotten your hands on Charlie Munger is really great. Seeking Wisdom is like a longer summary of Poor Charlie's Almanac by Peter Bevelin. There's a lot. More so than giving specific book recommendations, I think the thing that I have found most useful is when figuring out what you want to read is two things. And these are not my own rule. I didn't invent these, but they're rules I found useful. One is read multiple books at the same time, and don't be afraid to quit a book if you don't like it. So most people don't read enough because they pick one book and they only sort of like it, so they stop reading. I think if you read many things and you just jump from the thing to thing, like find something that's interesting you in the moment and keep going, you're just going to get more content in your brain that way. So that's been really good for me. And then the second is it's totally fine to reread as opposed to read something else.
100%. Huge on that. Yeah.
Read the thing that impacted you greatly the first time around, and you'll probably find something interesting and revelatory about it the second time around, versus trying to force yourself to something you don't really care about. Yeah,
because you also change, right? You probably have a different mindset, and so now you're reading something that's the same on paper, but you understand it differently. I will add just one more thing, by the way. I listened to a podcast with Tim, and the founder of Instagram. He added, he only reads books that are much more outdated. So he'll never read anything within a 10-year time span because it hasn't stood the test of time. So I felt that.
You just have to, you got to be careful with that stuff too. I agree. You read the source material. For example, you can read High Output Management by Andy Grove, and you don't have to read a bunch of management books that followed it, because they just are copying a bunch of stuff Andy Grove wrote about a long time ago. So if you read the source material, you can get a head start on the new stuff. The thing I'll warn people against, though, is you got to know the difference between a book you want to read and a book you want to have read. Because there's, right, like there are many books you want to have read, but you do not actually want to read. And if it falls into that second category, like read a summary, you're not going to get through it. Like you just want to tell people you read it. You want to have the knowledge you have from having read it, but you don't actually want to read that book. And like I got a bunch of those sitting on my shelf too, where like I want to have read it, so I bought it, but I don't actually want to read it. And that knowing the distinction is important, because it'll just keep you out of books you don't like.
Love it, man. Yeah, I'm going to keep that close. Well, listen, dude, if I say I appreciate this conversation, I think it's selling it short. Thank you a lot. Really, this was great.
George, thank you so much for the invite. This is super fun. You do your research, makes these conversations even more fun.